Hi everyone, I'm going to tell you something that will probably make you angry. Everything you've been taught about building wealth through dividends is designed to keep you poor. Not struggling poor, comfortable poor. The kind where you work 40 years, save diligently, invest in safe dividend stocks, and retire with just enough to not starve. That's not wealth, that's survival with a 401k. But there's a different path. One that Wall Street doesn't advertise because there's no commission in it for them. The dividend trap that destroys wealth. High yields look sexy on paper. An 8% dividend beats a 3% dividend, right? More income means faster wealth building. Except that's backwards. Companies paying massive dividends are usually dying. They're bribing you to hold their stock while the business crumbles underneath. When recession hits, those fat dividends vanish first. Investors chase yield, load up on 7% and 9% payers, feel wealthy watching quarterly checks arrive. Then economic stress hits, dividend cuts, stock price collapse, wealth obliterated. The company's still standing? The boring ones pay 3% to 4% that nobody noticed. That's why SCHD exists. What nobody tells you about ETF construction. Most dividend ETFs are garbage dressed up with marketing. They promise high income, they deliver high expense ratios, hidden fees, and portfolios stuffed with dividend traps, waiting to explode. SCHD costs $6 annually per $10,000 invested. Meanwhile, competitors charge $60, $90, even $120, and their performance consistently worse. Here's what makes SCHD different. Every company must have paid dividends for 10 consecutive years minimum. Already, you've eliminated 90% of dividend traps. Companies can fake growth for a few years, but they can't fake 10 years of consistent payments. Then comes the real filtering. 4 financial health metrics: cash flow to debt ratio, return on equity, current dividend yield, and 5-year dividend growth rate. Only profitable, financially stable, shareholder-friendly companies survive. You're buying 103 holdings proven to pay dividends during expansions, recessions, and market crashes. Wealth isn't built through high yields. It's built through reinvestment during market crashes. Take a position worth $50,000. At 3.8% annual yield, you collect approximately $1,900 yearly in quarterly payments. Most investors spend that cash. Big mistake. When you reinvest dividends automatically, something powerful happens during sell-offs. Your quarterly payment doesn't change, but the share price drops significantly. Stock trading at $28, your dividend buys X shares. Stock crashes to $23, same dividend purchases 22% more shares. When recovery happens, you own substantially more shares, generating substantially more income. Your cost basis is lower. Your dividend growth accelerates. This is the wealth transfer mechanism from scared money to patient money. SCHD has increased its annual dividend for 13 consecutive years, through multiple market crashes, through a global pandemic, through everything. Dividend growth has historically averaged high single to low double digits. That dividend you're reinvesting? It's growing faster than inflation. Why smart money moves opposite of retail. Institutional investors don't think in quarters. They think in decades. When SCHD underperforms during growth stock rallies, retail investors bail out. They chase whatever's hot. Meanwhile, institutions quietly accumulate positions. SCHD holds over $70 billion in assets. Nearly $6 billion flowed in over the past year during a period when SCHD trailed market returns. The smartest money in finance is looking up specifically when it looks boring. They're building positions at reasonable valuations before the next cycle favors dividends. You can follow retail investors chasing performance, or you can follow institutional money preparing for what's next. The portfolio architecture that works forever. Stop thinking about SCHD as just another holding. Start thinking about it as your wealth foundation. Foundation layer: 50% of investable capital goes into SCHD. Set automatic dividend reinvestment. Never touch it, let it compound quietly. Your other 50%? That's where you take risks. Growth stocks, individual picks. The SCHD Foundation protects you from catastrophic mistakes. Once your account grows beyond 6 figures, advanced structure. 40% SCHD as core, 30% in total market index, 30% cash reserves. That cash isn't sitting idle, it's ammunition. When markets crash 20%, deploy half into more SCHD at discount prices. Markets fall another 15%, deploy the remaining cash. This removes emotion. You have rules, you follow them. You ignore the noise. For serious wealth builders managing larger portfolios, use SCHD's holdings as your individual stock shopping list. Companies like Chevron, Bristol-Myers Squibb, Merck, ConocoPhillips, all cash-generating titans with fortress balance sheets. If you believe strongly in healthcare or energy, overweight those positions beyond SCHD's allocation. But maintain discipline. Never hold fewer than 8 individual names alongside SCHD. Concentration creates millionaires. Diversification keeps them millionaires. The tax mathematics that changes everything. SCHD distributions qualify as qualified dividends. They're taxed at long-term capital gains rates, not ordinary income rates. Depending on your bracket, that saves 15% to 20% compared to regular dividend taxation. On a $50,000 portfolio generating $1,900 annually, you're keeping roughly $200 to $300 extra dollars after taxes every year. Compound those savings over 30 years. You funded vacations, paid for a car, built additional wealth just from tax efficiency. Compare that to covered call ETFs generating ordinary income taxed at your marginal rate. Those extra percentage points in yield disappear immediately to the IRS. Why this strategy never expires? Profitable companies rewarding shareholders through dividends aren't temporary. They're capitalism's core mechanism. Market cycles will continue forever. Recessions will arrive. Tech bubbles will inflate and burst. Through all of it, quality businesses generating cash and paying growing dividends will keep performing. SCHD captures that eternal economic reality in a low-cost, tax-efficient, automatically rebalancing structure. The methodology worked at launch, works today, will work decades from now. Fear and greed drive markets eternally. Patient capital consistently transfers wealth for emotional decision makers. Your exact implementation plan. Stop overthinking and execute today. Open your brokerage account, search for SCHD, review current price and top holdings, decide your initial investment. Place the buy order, enable automatic dividend reinvestment, set up monthly or quarterly automatic purchases if dollar cost averaging. Then do the hardest part. Ignore it completely. Check quarterly to confirm dividend payments. Watch your share count grow through reinvestment. Notice the expanding annual income stream. But resist every urge to trade. Resist selling during market chaos. Resist taking profits when prices run. The investors who bought SCHD at launch and held through every market swing, they multiplied their investment several times while collecting growing quarterly income. The ones who traded in and out trying to time entries, they massively underperformed. Your choice is simple. Join patient wealth builders who understand compounding mathematics or chase shiny objects promising quick riches. One creates generational financial security, the other creates brokerage statements full of regret. The path to wealth was never mysterious. It was just boring enough that most people quit before seeing results. Don't be most people. Disclaimer, this is for educational purposes only. This is not financial advice. Consult a qualified financial advisor before making investment decisions. Past performance doesn't guarantee future results. This is Invest ED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies that Wall Street won't tell you. Investing smart, profitable investing.